Hey everyone, it's Your Name with the investors community. Make sure you hit that subscribe button and notification bell so you don't miss out on future videos about making your money make money. Today, we're diving deep into a topic that has huge implications for your investments, the US trade deficit. Specifically, in 2024, we saw the largest deficit ever, $1.2 trillion. How does this affect your portfolio? That's exactly what we're breaking down. We're looking at the top 10 countries contributing to this deficit, what's driving it, and how you can use this knowledge to your advantage as an investor. Let's get started. Alright, let's kick things off with the elephant in the room, China. In 2024 alone, the deficit with China reached a record $500 billion. The demand for Chinese-made goods, especially electronics and consumer products, remains incredibly high. This insatiable demand, coupled with China's lower production costs, has fueled this imbalance for years. But here's the thing. This situation is creating some interesting investment opportunities. Keep an eye on companies involved in global supply chains. Manufacturing is slowly shifting to other countries like Vietnam, offering a chance to get in early on the next manufacturing hub. It's all about recognizing the shift in the global landscape and positioning yourself accordingly. China is also a massive consumer market. As their middle class grows, so does the demand for foreign goods and services. This presents a huge opportunity for US companies looking to expand internationally. Next up, we're heading south of the border to Mexico, the second largest contributor to the US trade deficit. The relationship between the US and Mexico is deeply intertwined, especially when it comes to trade. One of the biggest drivers of this deficit is the automotive industry. Mexico has become a major hub for car manufacturing, thanks in part to lower labor costs and favorable trade agreements. This means that many cars sold in the US are actually assembled in Mexico, contributing to the trade imbalance. However, it's not all doom and gloom. US companies with manufacturing facilities in Mexico benefit from lower production costs, which can boost their profits. The close proximity of the two countries allows for efficient supply chains and reduced transportation costs. As investors, it's crucial to stay informed about policy changes, economic developments, and industry trends to make informed decisions. Let's shift gears and head over to Southeast Asia, where Vietnam is quickly becoming a major player in the global manufacturing scene. As Chinese manufacturing costs have risen, many companies have started looking for cheaper alternatives, and Vietnam has become a prime destination. This shift in manufacturing has been a boon for the Vietnamese economy, and has created some exciting investment opportunities. We're seeing rapid growth in sectors like electronics, textiles, and footwear, all areas where Vietnam is becoming increasingly competitive. For investors, this presents a chance to get in early on a rising economic power. Consider looking into Vietnamese companies that are benefiting from this manufacturing boom, or even US companies that are setting up shop in Vietnam to take advantage of the lower costs. Vietnam is still a developing country, and its political and economic landscape can be unpredictable. But for those willing to do their research and carefully assess the risks, Vietnam offers the potential for significant returns. Chapter 4: Ireland Pharmaceuticals and the Curious Case of the Irish Trade Deficit. Now let's hop across the globe to Ireland, a country known for its beautiful scenery, friendly people, and a surprisingly large trade deficit with the United States. A big chunk of this deficit comes down to one key sector: pharmaceuticals. Ireland has become a global hub for pharmaceutical manufacturing, attracting major companies from around the world. And guess where a lot of those medications end up? You got it, the US. This means that the US imports a significant amount of pharmaceuticals from Ireland, contributing to the trade deficit. For one, it highlights the strength and profitability of the pharmaceutical industry both in Ireland and the US. If you're looking for investment opportunities, consider researching pharmaceutical companies with a strong presence in Ireland. These companies are well positioned to benefit from the continued demand for medications in the US and globally. However, it's important to remember that the pharmaceutical industry is heavily regulated and subject to political scrutiny. Chapter 5: Germany, Precision Engineering, and the Price of High-Quality Goods. Next up, we're heading to the heart of Europe, Germany. Known for its engineering prowess and high-quality goods, Germany has long been a major trading partner with the United States. But this relationship also comes with a significant trade deficit. A big part of it comes down to the types of goods that Germany excels at producing. We're talking about things like high-end vehicles, specialized machinery, and precision instruments, products that often come with a premium price tag. Think about it, German car brands like BMW, Mercedes-Benz, and Audi are renowned worldwide for their luxury and performance. For investors, this situation presents a couple of key takeaways. Firstly, it highlights the importance of diversification. Consider investing in both US and European markets to balance your portfolio. Secondly, keep an eye on currency fluctuations. The exchange rate between the US dollar and the euro can significantly impact the cost of importing goods from Germany. Chapter 6. Taiwan, the unsung hero of the global tech supply chain. Now let's talk about a country that plays a huge role in our tech-driven world, Taiwan. You might not realize it, but Taiwan is a technological powerhouse, especially when it comes to semiconductors. Taiwan is home to TSMC, the world's largest contract chip maker, and supplies chips for everything from smartphones and laptops to cars and gaming consoles. This dominance in semiconductor manufacturing has made Taiwan a critical link in the global tech supply chain. The demand for semiconductors is only going to increase in the coming years as technologies like artificial intelligence, 5G, and the Internet of Things continue to advance. This means that companies like TSMC and other Taiwanese semiconductor manufacturers are well positioned for continued growth. Now, investing in individual companies can be risky, but you can also look into ETFs or mutual funds that focus on the semiconductor industry as a whole. This allows you to diversify your investments and potentially benefit from the overall growth of the sector. However, it's important to be aware of the geopolitical risks associated with Taiwan. Let's talk about Japan, once synonymous with cutting-edge electronics. Remember when Sony Walkmans and Nintendo Game Boys were all the rage? Today, Japan faces challenges like an aging population and competition from other Asian countries. Yet Japan still holds a significant trade surplus with the United States, especially in automotive and electronics. Japan's thriving robotics industry and advancements in AI and renewable energy offer growth potential. Chapter 8. South Korea. Riding the wave of semiconductors, ships, and global trade. South Korea is a global leader in technology, shipbuilding, and K-pop. Beyond catchy tunes, it's a force in international trade. Exports of semiconductors, vehicles, and ships drive its trade surplus. Samsung and Hyundai are household names, boosting the economy. Investing in South Korean ETFs can diversify your portfolio. But remember, geopolitical risks can impact investments. Chapter 9. Canada, our northern neighbors, and the energy connection. Now let's head north to Canada, our friendly neighbor and a crucial trading partner. The US and Canada share the world's longest undefended border and have a deeply integrated economy. When it comes to the trade balance, it's actually relatively balanced compared to some of the other countries we've discussed. However, the US does have a trade deficit with Canada, primarily driven by imports of energy products like crude oil and natural gas. Canada is rich in natural resources, and its energy sector plays a significant role in its economy. And while the US is also a major energy producer, it still relies on imports from Canada to meet its energy needs. As the world transitions towards cleaner sources of energy, Canada is well positioned to benefit. It has vast reserves of renewable resources like hydroelectricity, wind, and solar, and is investing heavily in clean energy technologies. For investors, this means that looking beyond traditional energy companies and considering investments in Canadian renewable energy companies or clean technology funds could be a smart move. Chapter 10. India, the software giant with a growing appetite for US goods. India has become a global hub for technology and outsourcing, with companies like Infosys and Tata Consultancy Services. The US has a significant trade deficit with India, driven by high demand for Indian software services and pharmaceuticals. As India's middle class expands, so does its appetite for foreign goods, including US products. This presents a huge opportunity for US companies in a growing market. The trade deficit, your action plan for smarter investing. So there you have it, the top 10 countries contributing to America's massive trade deficit in 2024. It's a complex issue with far-reaching implications, but, as we've discussed, It also presents some unique opportunities for savvy investors. Keep watching the investors community for more insights on how to navigate the complexities of the global economy and make smarter investment choices. Until next time,